Hey everyone, welcome back to Kitco News. I'm Jeremy Safran. Well, markets are digesting fresh U.S. PCE data that came out this morning showing core inflation slowed to about 2.5% year over year. Now, gold is holding around $3,300 on the spot side, despite Trump's tariffs being reinstated. And then we have, of course, this renewed geopolitical risk in the market, too. Now, we got to talk about copper because it's back in the spotlight. Ivanhoe's Kamoa-Kakula mine remains flooded, and there's a new peer-reviewed study out there warning that we'll need more copper by 2050 than in all of recorded history just to meet these new zero standard goals. Now, meanwhile, Glencore, one of the world's largest globally diversified natural resource companies, has just transferred $22 billion in assets to its Australian unit. That's a move investors say could lay the groundwork for the largest mining merger in a decade. And President Trump, well, he signed a new nuclear executive order fast-tracking permits for uranium and mining projects, calling strategic minerals essential to national security. So where is the smart capital going, and how should investors navigate this moment? Joining me is Rick Rule. He's the founder of Rule Investment Media and host of the Rule Symposium, which, by the way, is coming up July 7th through to the 11th in Boca Raton, Florida. We'll be there with Kitco News, full coverage, so do come and say hi. Now, Rick's contrarian calls have shaped resource investing for decades. He's been through 5 cycles and made a career out of buying what's unloved before it becomes essential. Good to see you, Rick.
Pleasure to be with you. Thank you.
Okay, we got nothing really to get to today, huh? There's nothing in the news. I'm kidding. Okay, let's start with, we were going on X this morning and kind of going through some of your tweets. And, you know, you've been very vocal on X about the economic storm clouds gathering, right? I mean, we got record debt, the stubborn inflation, and what you've called irresponsible governance. Now, you posted that taxpayers are getting crushed by both excessive taxation and unchecked spending. So let's start there. Let's unpack that macro moment, Rick. I mean, how is this impacting capital markets and the average investor right now?
I think that's probably the most important question of our epoch.
Yeah.
The arithmetic around government and the arithmetic around the crowding out of the private economy is something that's difficult for people to comprehend if they have normal lives. But I'm going to try and make it easy for people arithmetically. And by the way, I'm going to talk about American numbers as opposed to Canadian numbers because I know the American numbers. The Internal Revenue Service estimates that the aggregate private net worth of American citizens is $141 trillion. That's what all of us Americans collectively are worth. The on-balance sheet liabilities of the federal government, not including state and local governments or individual debts or corporate debts, just the federal government debt, is $36 trillion. 30 trillion net of the Fed's own balance sheet. So 30 trillion net debt. The difficulty is below that line. The net present value of off-balance sheet liabilities, which is to say Medicare, Medicaid, Social Security, federal pensions, military pensions, the net present value of unfunded federal promises in the United States exceeds $100 trillion. So if you add the on-balance sheet liabilities, 30 trillion, to the off-balance sheet liabilities, 100 trillion, and you subtract that to the net worth, the private net worth of Americans at $141 trillion, you only have $11 trillion left over. The on-balance sheet deficits increase by $2 trillion a year, meaning that you use up the net worth of Americans in 5 years. But the off-balance sheet liabilities also increase by $2 trillion a year. This is problematic. I don't believe, arithmetically, that there is any way that we can service our obligations, our entitlement obligations. The upshot of that for investors, where the rubber meets the road, is that I believe that we will have to allow the purchasing power of the U.S. dollar to decline so that we can honor our nominal debts while not honoring our real debts. We did that in the United States in the decade of the 1970s. In the 1970s, according to the Congressional Budget Office, the purchasing power of the U.S. dollar declined by 75%, not relative to other currencies, but in an absolute sense. And I believe because of this $100 trillion in unfunded entitlement liabilities, that the U.S. dollar will lose 75% of its purchasing power over 10 years. This is a crisis that we'll get through, just like we got through the decade of the 70s. But it's a crisis that will require preparation for people. And I suspect that they start planning for that, both in terms of how they save and in terms of what their expectations are for their retirement. I think people need to plan right now.
Yeah, a little bit late to the party if you're just waking up to it. I mean, it feels as though people are talking about debasement a little bit more now in this macro environment. And I mean, you've said that we're entering this new era of volatility after decades of relative, macro stability, if you will. I mean, the markets have been they've been crazy, if you, right? I mean, what's changed since the 1980s? How should investors kind of shift their mindset to survive and to profit from it?
Well, you make a great point. After the 70s, we had some moments of fiscal sanity in the late 70s and the early 80s. The size of the federal government never grew, never shrank, but it grew less rapidly. And we had real interest rates that were very, very, very high. We rewarded savers as opposed to spenders for a while. And that broke the back of inflation. We had a period, 1982 to 2022, that from an American point of view was pretty close to perfect. Declining real interest rates, declining nominal interest rates, a very strong US dollar, an influx of foreign direct investment. Americans were able to export their inflation to other countries through monetary policy. Equity markets responded to declining real interest rates by booming. My suspicion is that began to end in 2022 because that benign economic climate in the United States allowed us to take our aggregate federal debt relative to GDP from 30% in 1981 all the way up to 120% today. In other words, we went from being a country that had its obligations in pretty good balance in 1981 to a country where the obligations are wildly out of balance today. I need to say one more thing. At the top of the interview, you described inflation the way most people think of inflation. Most people think of inflation as inflation measured by the CPI, the Consumer Price Index. I might point out to you that whoever compiles the CPI doesn't shop where you and I shop. Common sense will tell your viewers, if they think about the cost of their own living in the period 2020 to 2025, that the idea that the CPI measures the deterioration in your purchasing power is farcical. First of all, the CPI doesn't measure tax. I guess for people who don't pay tax, that index could be partially valid. But look back at gasoline prices in 2020. Look at food prices in 2020. If you're American, look at healthcare costs or healthcare insurance costs. Look at rents. Look at mortgage payments. The truth is, I believe that the purchasing power denominated in US dollars is declining by more like 7.5% or 8% a year, not 2.5%. And for Canadians over the last decade, it's been worse, not better. So if you are looking at the CPI number as a gauge of the deterioration of the purchasing power of your savings, you are wrong. You need to understand that the purchasing power of your fiat denominated savings is declining at more like 7.5% or 8%. That means that if you buy a US 10-year treasury yielding 4.5%, that rather than making the difference between 4.5% and 2.5% or 2% real yield, you are actually losing more like 3.5% or 4% a year compounded. You need to change the way that you think. You need to change the way that you plan. You need to change the way that you spend, and you need to change the way that you invest.
Yeah, well said. Not to mention, every single time we cover those official data points, we get revisions, a couple months after anyway. Okay, well, we got to shift to hard assets and what that means then, because it almost feels like we're in this capital rotation away from consumption and into those hard assets. But I'm curious, why are growth stocks like Nvidia and still out, they're attracting these outsized inflows? I mean, gold ETFs saw $2.8 billion in outflows in May. So, I mean, is the market still chasing, quick upside over long-term protection?
I think two things. Well, the system probably isn't solvent in the long term. The system's highly liquid. There's a lot of cash in the system. There's a difference between liquidity and solvency. Solvency matters in the near term. Liquidity matters in the near term. Solvency matters in the long term. But the second thing is these big tech companies are really good businesses. I don't invest in them because I don't understand them, but I understand a lot about profit margins, and I love Apple's profit margin. I love Nvidia's profit margin. Investors who maybe pay less attention to balance sheets and income statements than I do just look at the fact that the tech trade has worked for 40 years. And
Yeah.
it's difficult to change people's perception. I think if you asked a lot of viewers on your show what they expected NVIDIA's earnings to be like 5 years from now and what they thought about NVIDIA's technology relative to their competitors' technology, they would probably look at you askance and say the stock's going to go up. Those are very, very, very different investing stratagems.
Yeah.
I'm not criticizing technology investing, by the way. I'm just saying that because I don't understand the intricacies of the technology, I don't invest in technology stocks. Others, I suspect, who know as little or even less than I, invest in them simply because they've gone up for 40 years.
Mhm. Yeah, and everyone thinks that they're going to continue to keep going up, it appears there too, to your point. I got to switch over to, talking about this theme on gold and trust, because we're learning this morning that Germany's gold reserves are once again a flashpoint. Lawmakers there are calling for repatriation of about 1,200 tons stored at the New York Fed. It's a Cold War era arrangement that now looks politically outdated. I mean, Rick, you've said that trust, not credit ratings, is the true foundation of money. If a major ally like Germany is questioning the safety of the U.S. held gold, what does that say about the global perception of American monetary stewardship?
Unfortunately, the U.S. government and the body politic in the United States, the voters, I think have chosen to weaponize the dollar.
Mm-hmm.
And I think that other countries view that askance. Weaponize the dollar in two senses. The U.S. government has used U.S. dollar hegemony uh, through the SWIFT banking system to extraterritorially impose U.S. power on other cultures. There was a point in time where New York was the center of global finance. The Germans in the 1950s or 1960s would have had to leave their gold in New York because it collateralized transactions that the German government entered into. There are now as many US dollars outside the US, the so called Eurodollar accounts, as there are inside the U.S. And the idea that Germany would need to make its gold available to creditors only in New York is nonsense. It's just as easy to borrow U.S. dollars in Frankfurt or Geneva or London as it is in New York. And regardless of what you think of the efficacy of the Russian incursion into Ukraine, the U.S. response, which was to steal $300 billion worth of Russian Treasury securities, U.S. Treasury securities, called into question the honor of the U.S. government with regards to other countries that might have policy disputes with the U.S. In a way, at least with regards to China as an example, it's probably irredeemable.
Mm-hmm.
The second thing I suspect in terms of Germany is the unpopularity of Mr. Trump himself and the sort of bellicose um, assertion of U.S. interest relative to everybody else in the world. He is personally unpopular in many places. I think this move in Germany, in one sense, reflects the German politicians' awareness of the distaste that German people have for Mr. Trump. And I think there's a lot of political populism in the move to repatriate German gold from the United States to Germany. In other words, I think it's partly a political as opposed to merely an economic act.
Yeah, no, that's what I mean. I mean, should the U.S. even care about it, or is the risk of foreign divestment from dollar reserves still overblown?
I think it is.
Yeah.
My friend Doug Casey, who I know you've interviewed, uh, once said the US dollar is the worst currency in the world, with the sole exception of all of the others. The US dollar will continue to be the world's reserve currency for the balance of my life. For the record, I'm a very healthy 72-year-old. But US hegemony will be less and less. The US dollar won't be supplanted, but we will see, as we have seen, other settlement mechanisms begin to evolve so that the US dollar, while still dominant, will be less dominant.
Yeah. Okay, we got to shift over to Trump's new economic policies because the U.S. Court of Appeals just reinstated this broad-based tariff while his latest executive order prioritizes domestic nuclear energy and obviously what we talked about, this critical mineral projects that he's working on or others are working on that hopefully kind of, lays out some red carpet for them. What's your take on this shift, though? It seems like destigmatized. Everyone knows now. And what does it mean for resource investors?
Well, two things there. Even the Biden administration began to come around towards the end of the Biden administration to the importance of domestic resource development. The Biden administration, for most of his time in office, was very anti materials, oil and gas, nuclear. Towards the end of the Biden administration, the ridiculously titled Inflation Reduction Act changed, as an example, the status of uranium from a pariah to a subsidized product. So Mr. Trump, in one sense, reflects a trend in motion. There's a lot of things that, despite his assertions to the contrary, he can't do. But one thing that he can do by executive decree is reverse the executive decrees that were put in place by Clinton, by Obama, and by Biden.
Yeah.
And in doing that, he can do a ton of good. He doesn't need Congress to help him. He doesn't need the courts to help him. He doesn't need to change legislation. All he needs to do is reverse the executive decrees that were put in place by each of Clinton, Obama, and Biden. And that is a sea change. The granting of preliminary federal approval for a uranium mine in Utah after 2 weeks is, from
Yeah.
my point of view, astonishing. If you juxtapose that with the permitting process, admittedly, some of it was state and local, for the Resolution copper mine in Arizona, which is now 26 years and counting, there's a sea change.
Yeah.
And that sea change is happening too in the American oil and gas industry. The Biden administration wouldn't not approve things, they just wouldn't answer, meaning that gas gathering systems, gas storage systems, gas transmission systems, liquefied natural gas infrastructure went nowhere for 4 years. My suspicion is that the next 4 years will be very, very different. And that inures to the benefit both of the United States, but more particularly to the benefit of Kitco listeners who are natural resource investors.
Yeah, that's what I was going to say. Okay, we've got to get into natural gas, and we're going to talk a little bit about stocks. Before we do, on this topic, I mean, with this new, this new EO that he signed, I mean, are we actually going to see government capital flow into strategic mining, or is this another round of regulatory talk without execution?
I hope the latter.
Yeah.
I hope that the industry is not able to loot the taxpayer for direct subsidy. The more federal nexus you allow in your business over time, the worse your business becomes. I would hate to have the US federal government, even while it purports to be my friend, be my partner.
Yeah.
All I want them to do is get out of the way as much as feasible. The truth is that subsidies are transactional and politicians are transactional. Subsidies are a way to reward your friends, not coincidentally, attract campaign contributions, and
Hmm.
punish your enemies. Mr. Trump, like all of his predecessors, is extremely transactional. Tariffs are the same thing. Tariffs are taxes. There's no way around that. Taxes are bad. But for Trump, tariffs are a way to set up an infrastructure of problems that you can be paid for solving. You can reward your friends, you can use them as poker chips to make other transactions occur, and you can punish your enemies. Very, very, very tempting to set up a superstructure of subsidies and tariffs so that you can be more transactional as a politician.
Yeah, yeah, well said. Okay, well then what does that mean for, the energy sector? I mean, we got to talk about uranium and oil too, but I mean, uranium prices are recovering a little bit and Encore just expanded its Texas licenses. SMRs are obviously gaining a lot of traction. What names do you like now? And are US listed uranium stocks still investable at these valuations?
I think it depends on who you are. The last
Mhm.
time I was on Kitco, there was a lot of hate in the uranium space. And I was able to say these stocks are oversold. You don't have to believe in the uranium thesis for 5 years. All you have to believe is that the hate will subside. Well, the hate subsided. Those stocks are up 35 or 40%. If you're a trader, take money off the table. I took money off the table in my trading positions. I've sold about 20% of my uranium stock position. But the uranium business over the next 5 years changes fundamentally, both because the regulatory in the United States has gone from being hostile to being friendly, but also simply because the structure of the market, the uranium market, has changed from one being dominated by the spot market to one being dominated by the term market. In uranium, unlike any other mined commodity, the producer and the consumer can enter into a contract with 5 year duration, 10-year duration, even 20-year duration, so that there's certainty in terms of price and volume. This means that people will enjoy a lower cost of capital because a purchase contract, a purchase and sales contract with a credit grade counterparty is literally collateral at the bank.
Hmm.
In the US, this is going to be particularly attractive, I think, given that the US is the world's largest uranium consumer and has the largest number of credit grade counterparties as buyers. And also because the US produces so little uranium relative to what it consumes, that the US government has decided that it is in its strategic interest to favor US produced uranium. I personally don't think that's a particularly wise outcome. I think relationships between the United States and Canada, irrespective of elbows up, is sufficient that Saskatchewan uranium is probably as secure for Americans as Wyoming or Texas uranium. But truly, it doesn't matter what I think. The fact is that the administration has decided, perhaps for domestic political reasons, that we will encourage uranium production in the United States. For US based uranium producers or developers, this is a wonderful thing.
Yeah, Rick, are you looking at like picks and shovels on that market? I mean, are you looking at towards the miners on the uranium side, or do you see more on the technology like SMRs?
I have had a moderately successful track record on the technology side. I've had a very successful track record on the resource side.
Yeah.
So I stick personally to businesses that I know well. I understand exploration and production. I understand mine finance. I understand metals debt markets. I understand technology much less well. So, although I think there's a lot of money to be made on the technology side, I don't think at age 72 I'm the right guy to make it. I make money on the miners.
That's good. Okay, what about crude? I mean, we've talked oil and gas before. I mean, it's hovering around 60. Natural gas and LNG getting a lot of attention. Are you watching any oil and gas names here, or is the energy trade past its prime?
That's the business I came from.
Yeah.
I came into the mining business from the soft rock side, the oil and gas side. I still like the business better. $60 a barrel constrains sustaining capital investment.
Hmm.
Uh, right now, the International Energy Agency suggests that the industry as a whole, including state-owned firms, is underinvesting in sustaining capital investments to the extent of about $1.5 billion a day. This impacts the industry's ability to maintain supplies at current levels 2 years or 3 years out, and that implies higher oil and gas prices. But the most efficient producers, including the Canadian producers, make a boatload of money at 60.
Hmm.
Although the price of crude is likely to go to 75 or 80, uh, there are a lot of companies that make a lot of money at current prices. The US industry, if you look at the enterprise values of the companies relative to the net present values of their free cash flows, are cheap. Cheaper yet, if you think we're headed to an $80 world rather than a $60 world. The Canadian producers are selling at substantial discounts to the US producers.
Hmm.
They are doing that, I think, because of the Canadian federal elections. I think that although Mr. Carney campaigned on a platform for change, he may not change with regards to his stance on climate. I continue to own Canadian oil and gas companies because I believe that the budget that Mr. Carney tabled yesterday,
Yeah.
485,
Without anyone in Parliament.
yeah, against $312 billion in income. I'm not sure how that arithmetic works. without increasing oil and gas production and increasing taxes at the federal level on oil and gas production. I think Mr. Carney's stated climate change agenda relative to finance will run into the reality of a $500 billion budget against $312 or $350 billion in income. I think that arithmetic is insurmountable without his at least covert support for the Canadian oil and gas industry. I may be wrong. It may be that despite the fact that he's a banker, he can't add and subtract, but I don't believe that to be true.
And I mean, so are you watching companies in Canada with that, these evaluations a little bit lower? Is there still a nice haircut? Can you still buy some of these dips? I mean,
I
Whitecap,
am.
Birchcliff, yeah, you are. And dividend
I am.
plays
I
too,
mean,
no?
listen, the Western Canadian Sedimentary Basin is a unique gift, and relative to similar basins in the United States, like the Permian, it
Mhm.
is really, really, really undrilled. Canada also has a great regulatory infrastructure, a great physical infrastructure, and a spectacular human resources infrastructure. These are very well run companies. Companies like Freehold, companies like ARC, companies like Tourmaline, Birchcliff, Peyto. These are world scale companies that are selling at substantial discounts to their US peers, despite the fact that, at least in a geological sense, they have superior growth profiles.
Yeah. Okay, switch over to metals because the viewers love when you give them a stock pick like that. By the way, gold. Obviously, we know it's just below 3,300 after this soft inflation print. But you said gold tends to move late in the cycle. Are we nearing the moment, or do you expect another shakeout before we see some new highs?
But we could have a little shakeup.
Yeah.
I don't care. Listen, I maintain liquidity in things like the US dollar and the Canadian dollar. I save in gold.
Hmm.
And what happens to the gold price in the near term is absolutely irrelevant to me. I hope I'm wrong, to be honest with you. You'll remember earlier in this interview, I suggested that the only way that the United States has out of its fiscal morass will be to allow substantial deterioration in the purchasing power of the US dollar. And you will remember that I discussed that in the decade of the 70s, according to the government itself, the US dollar lost 75% of its purchasing power. It is not coincidental that during the period of the 1970s, the gold price ran up 30-fold.
Hmm.
I don't want Kitco viewers to go away saying Rick Rule said the price of gold is going up 30-fold. That's not what I'm saying.
Yeah.
But I believe that over the next 10 years, gold's appreciation, at least in nominal terms, will mirror the devaluation of the purchasing power of the US dollar. I don't own gold because I think it might go from 3,300 to 3,500. You may recall you interviewing me some time ago where I said,
Hmm.
I don't own gold because I think it might go above 2,000. I own gold because I'm afraid it's going to go much higher. If you allow the purchasing power of the US dollar to decline by 75%, which is what I think happens over the next 10 years, arithmetically, it makes absolute sense that as a consequence of that, the nominal price of gold rises threefold or fourfold. So I don't own gold because I hope it'll go to 3,500. I own gold because I'm afraid it'll go to 12,000.
Yeah. And do you think retail investors are kind of following suit? I mean, they're listening out there. Gold ETF outflows suggest that they're still quite hesitant. I mean, is that a contrarian buy signal or, a sign that capital is chasing Bitcoin and these other high beta trades instead?
I'm not sure what it's a sign of, to be
Yeah.
honest with you. I know that my own database of investors who are interested in natural resource investing grows by about 50 people a day.
Mhm.
What is of interest to me is that the growth in the database isn't coming from the usual suspects. The usual suspects look like me, old, fat, bald, rich white guys. That's what the gold industry has been about for 40 years. The growth in my database is probably 75%
Wow.
people at 50. 35% of the new people in my database are female. We never saw that before.
Hmm.
What we're seeing is that interest in gold now is more global than domestic. So, at the same time that there are outflows from gold oriented ETFs, more specialized gold products, as an example, the Sprott physical gold trusts,
Mhm.
are having substantial inflows. And retail investment in gold outside the US, particularly in India, Pakistan, China, Taiwan, Korea, Vietnam, is very, very strong indeed. So what we're seeing is an international gold market. We have better ways of keeping statistics in the United States because we can measure inflows and outflows to ETFs.
Mhm.
But at the same time that we're seeing disintermediation from retail gold products in the United States, we're seeing increased gold ownership and hence escalated gold commodity prices on a global basis. The market's just changing.
Yeah. And what does that mean for, I mean, let's talk producers for a minute. Have the Agnicos and the Barricks already re-rated, or do you see that there's some real upside in the large caps?
Yes and yes.
Yeah.
What we saw, if you go back to 2023 as an example, there was a lot of frustration on the Kitco site about the fact that the gold price was up, but the gold stocks weren't up.
Mhm.
That was easy to explain. Gold itself had a buyer, foreign central banks, and those foreign central banks didn't buy gold stocks. So an asset class that had buyers went up, while an asset class that didn't go up. The other thing that happened was that as the gold price went up, the cost to produce gold went up too. So the margins in 2023 didn't increase. When the momentum in gold continued into 2024, something very different happened. The price of gold, the increase in the price of gold outpaced the increase in the price of inputs to produce gold, and producer margins began to expand. That increase in producers' margins, coupled with the perception around investors that gold was a real asset class, meant that the producers who demonstrated performance went crazy in price. Look at Wheaton, look at
Yeah.
Agnico Eagle, look at Alamos, look at Lundin Gold, look at Kinross. The people who delivered sustainable increases in margins were welcomed with 50 to 100% share price increases in the period January 24 to, let's call it, March 25. If you examine prior bull markets, what you will see is that trough to peak, the aggregate of the equity indexes in gold bull markets can increase by 250, 350, 500% peak to trough. So, yes, the best of the best have moved. And yes, there's a lot of room left in the sector. If
Mhm.
I'm correct, and over the next 10 years, the purchasing power of the US dollar declines by 75%, and gold experiences a concomitant nominal rise, the amount of room left in producer margins for the best of the best is extraordinary.
Mhm.
What happens in gold bull markets, of course, is that as the best of the best attract the capital, their share prices increase at a faster rate than the rest of the market. And value arbitrageurs begin to look for better value propositions in lower quality companies. If that doesn't happen, the very high quality companies, the Agnico Eagles, take the other ones over. At
Yeah.
any rate, it resolves itself. So leadership in the market will, over the course of the bull market, change from the best of the best down the value chain. Many investors, many speculators would probably be better off playing the bull market simply by owning the best of the best.
Mhm.
They will likely underperform the equity aggregate over time, but they will do so with much less operational risk. Those investors who pay attention to the Kitco site, who pay attention in how to speculate or how to own gold stocks that are lower on the quality trail, can generate alpha if they're willing to do the work and if they're willing to take the risk. At any rate, my suspicion is that the next decade will be extremely beneficial for gold investors at the expense, I'm afraid, of broad society.
Yeah, of our dollars and our fiat in the pocket. Okay, so they're printing cash on the major side. They're gonna, I mean, it's been remarkable to see some of these revenues, and as you talked about, these all-in sustaining costs coming down. On the junior side, I mean, you and I have talked about this. You always say be selective, don't follow marketing budgets, as we know. Any names that check the boxes right now? You know, high-grade geology, real permitting momentum, and maybe some M&A potential.
I think we've seen those stocks already begin to move,
Yeah.
and they have a whole bunch of a whole bunch of different themes. In Canada, we've seen a wonderful exploration success, Snowfields.
Mhm.
Uh, 10 million ounce deposits, even remote 10 million ounce deposits like that, with that kind of grade are rare. Somebody's going to have to own this thing. The guys who have performed, like G Mining, they're going to be able to continue to form. They have a durable competitive advantage. You have seen a growth pipeline built in. The royalty and streaming names, the smaller royalty and streaming companies, haven't repriced. If they don't reprice, the little guys are going to be taken over by the big guys. That's the way it works.
Yeah.
Lower cost of capital is a definable competitive advantage. And if the cost of capital doesn't equalize to some degree between the lesser ones and the bigger ones are going to grow by taking over the little ones. There's a lot of room in the junior space. We're early, make no mistake. Eaton, Franco are going to continue to outperform the rest for a while. But when the rest play catch up, I've seen this before. I saw it in the 70s. I saw it in the early 90s. I saw it in the 2000 to 2006 period. When the bull market gets longer of tooth, when the generalist investor comes in the space, there will be more equalization of value through the value chain. And the little ones will begin to outperform and eventually greatly outperform the big ones.
Yeah, that's what I was going to ask you. I mean, you've seen a lot in this market. You've been through this. We talked about it in the intro. Is this where it gets exciting for you? I mean, Glencore just shifted that $22 billion in global assets into its Australian arm. Obviously, a potential setup for a mega merger. What does this signal about long-term positioning? And should investors expect an M&A wave that's, just starting? Where's it going to go from here?
Well, now, of course, the viewers need to know that we've moved away from a gold discussion to a broader materials discussion.
We have.
That's an interesting discussion, too. My suspicion is in the near term, industrial materials, including, by the way, energy, which I'm a bull on, are going to be softer than people expect. I think we're in the early stages of an economic slowdown. An economic slowdown in the near term is hard on industrial materials prices. But that obscures the fact that 5 years from now, 6 years from now, 7 years from now, we are going to experience supply shortages across a broad range of industrial materials, oil and gas to be sure, but also copper, also met coal. My apologies to Greta Thunberg. And I think that the move you see in Glencore has a lot to do with the anticipation of that. We are going to see extraordinary opportunities in the industrial materials and base metals space. And those opportunities will avail themselves most dramatically to companies with a lower cost of capital. That is to say, bigger companies. The Glencore people are probably financially the most astute players in the base metals and industrial materials space. Seeing what's coming over 5 years, both in terms of opportunity for investment, but also in terms of cost of capital, they understand that the very largest companies in the world have the most trading liquidity, have the most access to equity ETF and index inclusion, and hence the lowest cost of capital.
Yeah, Rick, you just talked about that cost of capital. Let's stay there because, I mean, private credit's demanding 12 to 14% hurdle rates. Public equity is still being discounted. Is the capital stack broken? And what does that mean for funding in the next wave of discoveries?
Well, given that I'm a private equity, or pardon me, a private debt provider, I would
12
suggest
to
that the
14 is a little low.
is very, very, very attractive. If I had my choice between a 7.5% yield for subordinated debt on the Toronto Stock Exchange or a 15% yield privately with the same credit, obviously, I would prefer 15 to 7.5. And I'm lucky enough to be getting that now. I think that partly the capital stack reflects the politicization of credit. The fact that, as an example, the Basel III banking accords are fairly specific about reserve requirements for chartered banks by credit score. And so you have the companies that are able to access credit on balance sheet that are investment grade credits. And there's a lot of money from the chartered banks and also from the insurance companies that can come into those credits with less regards to reserve requirement, debt to equity ratios. Then you have a whole different set of companies that don't have access to investment grade credit that have to attract capital on a project basis. The great divide really is your credit rating. For those people who are in the club, on the debt side and can borrow on balance sheet with collateral other than the deposit that they're putting into production, they have access to historically cheap credit. For those who don't, uh, for those companies that have to borrow on a limited recourse basis against the project that they're financing into production, they have to pay market rates for credit, which are much higher,
Mhm.
unsubsidized.
Yeah. I got to ask you, I mean, you're wearing the bank shirt there. Any updates with Battle Bank?
Yeah. Our last bank, EverBank, I think from preliminary application to final approval took 19 months.
Yeah.
The regulatory climate has changed. And with this bank, we were at 54 months and counting. We've short circuited that. We've gone out and made an agreement to buy a little bank, nationally chartered bank. And our new application won't be a de novo application. We will be asking the regulators to allow us to increase the capital of this little bank. That usually isn't a big regulatory hurdle. We expect to be open for business really quickly. We expect regulatory approval. I'm going out on a limb here, but we expect regulatory approval within 30 days, and we
Mhm.
expect to be able to open open for retail business about 90 days after approval.
Yeah, great to hear. I know you've been working hard on that one. And also busy, man. I mean, you got this Rick Rule Symposium, obviously in Boca Raton, July 7th to the 11th. We talked about it. We'll be there. We're excited to be there, of course, every year. What can investors expect? What kinds of companies are coming, and what's the macro themes that'll be dominating this year?
Well, first of all, I'm delighted to have Kitco back. When we
Excellent.
had the conference in Vancouver, we had Kitco as a reporter and a presence for many years. And so, from the bottom of my heart, thank you and welcome back.
Yeah,
The
I'm
conference
looking forward to it.
itself, some people have told me it's in its 30th year.
Wow.
Time flies when you're having fun. It's a different conference than the others
Hmm.
for a whole bunch of reasons. The first reason is that we give you global macro in a way that the CBC and CNBC don't give it to you. We don't have journalists or
Hmm.
influencers covering policy. We have policymakers covering policy. U.S. policy will be discussed by David Stockman, who ran the Office of Management and Budget in the Reagan administration. Not a journalist, a player. Daniela DiMartino Booth will talk about the Fed, former researcher at the Fed. Nomi Prinz will talk about Wall Street, former partner at Goldman Sachs. You get the picture.
Yeah.
Once we have presented an alternative view of the way the economy works, we will give you analysts and portfolio managers who have 30 or 40 years real world experience in natural resources and precious metals, people who have invested through bull markets and bear markets, people who have allocated billions of dollars to the sector successfully for a very long period of time. What you won't get is a young analyst from a second tier brokerage firm who failed as a bond analyst, who failed as a crypto analyst, and who failed as a pot analyst. Uh, that isn't what you'll get.
And then started a new lander page.
Correct.
Yeah.
Correct. We move on from there to our exhibitors. At every other investment conference I know of, the qualification to be an exhibitor is a check that cashes.
Mhm.
At our conference, every single public company exhibitor is owned in accounts owned and managed by the conference sponsors. Doesn't mean that the stocks go up necessarily, but it means that every single exhibitor has been vetted. At every other conference I know, the qualification to be an exhibitor is merely a check that cashes.
Yeah.
We have the living legends, which is a group of entrepreneurs, the Randy Smallwoods, the Robert Friedlands, the Ross Beatties, the Bob Quartermains of the world, who have built multi-billion-dollar companies from scratch, telling you how they did it, telling you how to identify the $20 million company that's going to become a $2 billion or $3 billion or $4 billion company. The upshot of all this is that I get to make my attendees a really extravagant promise. Whether you attend in person, July 7th through 11 in Boca Raton, or whether you attend virtually, live stream, if you don't think for any reason that you didn't get your money's worth, I'll give you your money back. Absolute ironclad money back guarantee. I'll do something else for you too. We've interviewed or are interviewing every single exhibitor before the conference. Those interviews are available at the Rule Classroom and they're available at YouTube in the Rule Investment Media website. So you can come to the conference already knowing what exhibitors you are interested in. We will make the recordings of the proceedings available to you for a full year. because we're going to give you between 50 and 55 hours of information over 4 days, more than you can possibly absorb. Because of that, you'll be able to refresh your memory with the conference recordings for a year, and you'll be able to participate in discussion groups about the conference and the exhibitors at the Rural Classroom for a full year, comparing notes with other investors. This value proposition, high quality macro, high quality exhibitors, high quality portfolio managers, uh, allows me to say to you, if for any reason you don't believe you got your money's worth, you get your money back. Now, that's topical because tomorrow the price of admission goes up.
All right, you heard it here. Jump over. Again, Rick Rule, I got to say, it makes it easier for us because we know who we're interviewing and we know that they're of substance. And of course, always, a lot of those folks are Kitco's favorite guests. We love having them back. I appreciate this, Rick. Thanks again.
Thank you. I understand that you visited my friend Bob Quartermain in South Dakota, and I really, really, really look forward to your discussion of a wonderful deposit with a wonderful human being in front of it.
Yeah, thanks, mate. I appreciate that. It's going to be coming up on Kitco Mining. We visited 2 juniors on site. Just a remarkable place to watch the homestake being reborn once again with these gold prices above 3,000. Thanks, Rick.
Thank you.
All right, I appreciate it. And for full access of his upcoming Rick Rule Symposium in Boca Raton, July 7th to the 11th, check the link in our description and we will see you there. For more expert insights on gold, uranium, and of course, resource investing, stay tuned right here on Kitco News. I'm Jeremy Safran. We'll see you next time.